private equity has exploded in size over the last 2 decades. The industry has grown by an astonishing 20 times, transforming from a niche market into a financial behemoth. More money is chasing private equity deals than at any point in history. This surge of capital has created a paradox of success. With so much money to deploy, finding genuinely attractive investment opportunities has become increasingly difficult. The competition for good companies is fierce, driving up prices and squeezing potential returns. A core issue for investors is the industry's notoriously high fee structure. The standard model, often called 2 and 20, involves a 2% annual management fee on committed capital and a 20% performance fee on profits. These fees are charged regardless of whether the fund is actually outperforming the market. For the end investor, this means a significant portion of the gross returns is siphoned off by the fund managers. After these substantial fees are deducted, the net gains can sometimes be less impressive. In many cases, investors might have achieved similar or even better results by simply investing in a low-cost public market index fund. The engine of private equity's returns has traditionally been leverage. Funds borrow heavily to acquire companies, using debt to finance a large portion of the purchase price. This amplifies returns, as any increase in the company's value generates a much larger profit on the smaller slice of equity invested. However, this reliance on debt is a double-edged sword. In a slowing economy, the same leverage that magnifies gains can also magnify losses catastrophically. If a portfolio company's earnings falter, its ability to service its high debt load is compromised, dramatically increasing the risk of bankruptcy. Another growing challenge is the difficulty of exiting investments. The traditional exit routes, such as selling a company through an initial public offering (IPO) or to a strategic corporate buyer, have become less frequent. The IPO market has been tepid, and corporate buyers are more cautious in an uncertain economic climate. This has led to a controversial practice known as pass the parcel. Some private equity funds are now selling their portfolio companies to other private equity funds. This allows the selling fund to realize a return and return capital to its investors. But it raises questions about whether any real value has been created or if assets are just being recycled within the same ecosystem. The primary investors in private equity are not individuals, but large institutional players. Pension funds, which manage retirement savings for millions of workers, are major allocators to the asset class. University endowments and foundations also invest heavily, seeking high returns to fund their operations and scholarships. Other key investors include insurance companies, sovereign wealth funds, managing national wealth, and ultra-wealthy family offices. These institutions have long-term investment horizons and a high tolerance for illiquidity. They commit capital for years, hoping the potential for outsized returns justifies locking their money away. Despite the industry's allure, criticism is mounting. The once reliable outperformance of private equity has become less predictable. With many recent funds delivering disappointing results, the gap between the top-performing funds and the rest has widened considerably. The fundamental justification for investing in private equity has been the illiquidity premium. This is the idea that investors should be rewarded with extra returns for the risk of having their capital locked up for a decade or more. Increasingly, critics argue that this premium has evaporated, and the net returns no longer compensate for the high fees, high leverage, and lack of transparency. So, why does money continue to pour into private equity? A primary driver is the persistent belief in its potential to generate high returns. The legendary success stories of the past continue to attract investors hoping to replicate those gains. Furthermore, institutional investors are constantly seeking diversification. They aim to build portfolios that are not solely dependent on the performance of public stocks and bonds. Private equity offers an alternative that is perceived to have a low correlation with public markets, even if that perception is sometimes debated. Finally, private equity offers access to exclusive deals that are simply unavailable to the general public. This exclusivity carries a certain prestige and the promise of participating in unique value creation opportunities. For large institutions, being part of this private club remains a powerful draw, keeping the flow of capital strong despite the growing risks.